All right, welcome back. We're going to talk about some filters that are going to help us avoid some situations that will prevent some losing trades and will increase our odds and our winning percentages, which of course goes right to the bottom line, helps our trade plans succeed that much more. So first I want to point you to the attention of this chart here. It's hard to miss. It's a pretty ugly looking chart. You can see how it's trading up and down and up and down with very low range. And you might say that this is a pretty choppy market in here. And this could happen anytime, but in particular, you're going to find that this happens on Forex leading up to a big major report like non-farm payroll, for example, which exactly is what's happening right here. All this is a few hours before, during the European session, leading up to the big economic report of the month, non-farm payroll. And so this kind of price action is predictable. You could expect this quite often, especially in Forex charts. Hopefully most of you did get the free chop indicator, which you could see is part of the Counterpunch Express. And if you did, you would have learned how to use it because that free indicator came with training. I'm going to refresh your memory in case you forgot or if you didn't get this indicator. And I want to talk about the dots that you see along the zero line. Okay? Sometimes you only see half dots if you don't have anything above the zero line to kind of change the scaling. All right? But the dots are very apparent, and when those dots show up, you have to be careful because you're going to be selective with the trades that you take. Okay, there's a rule that we use. First of all, this is called the chop zone. And it doesn't mean that we don't take trades, but there are some trades we just want to avoid and other trades are okay to take. In this case, we've got the price action below the 50 EMA as it's coming down, right? Of course, that's below the 200. We can't be afraid to take trades. Of course, if you see this kind of price action, you can always decide it's just not for me. I don't want to take trades in this market condition. If it's in front of non-farm payroll, no one's going to blame you. However, really great trades do come out of tight consolidation and choppy markets. You're going to have a good chance in catching some of them, and then of course avoiding getting whipsawed if you follow this rule. When you get into the chop zone, based on these dots, you don't want to take trades that go against the 50 EMA. But you can take trades that are in agreement with the direction of the 50 EMA. And it's a real simple rule. If you're below the 50 EMA, then you can take short trades, but not long trades. Okay? If you're above the 50 EMA, of course, you can take long trades, but not short trades. And I'm referring to the entries themselves. Okay, now sometimes you're going to get into a chop zone situation where the price is right on the 50 EMA, and the price will sometimes get stuck on it, and I'll show you an example of that in a moment. And when that happens, then you're going to get a setup above the 50 EMA. It's going to be okay to take because that's the rule, right? You're above the 50 EMA, you can take longs. And then you might get a setup below the 50 EMA, and of course you can take that too. And those are situations where you could get triggered in to a false trade or a false breakout. Okay, and we'll talk about that. But what I want to point out here is notice how the short trade works to the downside, almost hits that target perfectly. You can see all these short trades. This one, of course, is a real small setup, and we're going to talk about that also. That's a filter. Now remember, this is not even in the chop zone yet, even though it is choppy. The chop zone hasn't activated. But notice that this purple trade triggers in. You're below the 50, triggers in short. It ultimately works its way down, hitting targets. Whereas the long trade against the 50 EMA, even though it's real small, both these trades, they do trigger in, they hit the 50 and they continue to move lower. So you're going to have some nice trades that can come in and out of the chop zone, but the rule is to avoid trades against the 50 EMA. If you're below the 50, if the entry is below the 50, that means you can go short, not long. It's not our job to try to avoid all losing trades. We avoid choppy situations based on the rules of our trade plan. Quite often we're not going to trade during times when the market tends to be choppy. And we'll avoid some losing trades by using this rule based on the chop filter. We're not going to avoid all losing trades. We're not going to try because we know that that's an exercise in futility. You can write some rule that you just don't take any trades when you're in the chop zone, and then you're going to miss some really big moves that would have had you positive and quitting for the session. The other thing I will say, though, is if you're coming into a session and you see that the chop zone is going for quite a long time, that's also a precaution that it's very choppy, and you just want to be careful. You may want to avoid all trades during that time. It's an option. All right, let's look at another example. So there are some exceptions to the rule. Notice here we're in the chop zone and we're above the 50 EMA, and of course the rule is when you're above the 50 EMA you shouldn't take shorts against the 50 EMA. The one exception would be if you're so far above that you have a lot of room to be able to get down to it, because we know that the price wants to try to work its way back down to the 50 EMA. So notice that you've got room to come down and hit that target 1. The 50 EMA is quite a bit further down. And so in those situations, you can take those trades. That's optional. It might be easier just to stick with the rule. Below the 50, don't take the trade. And every now and then, a filter will filter out a winning trade. That just goes with the territory. You'll filter out a lot of losing trades, and you'll also filter out some winning trades from time to time. But if you're just patient, look what happens here when it actually works its way below the 50. Now you can take the short. It's in a new chop zone. And notice how it comes down with the direction of the 50 and gets pretty close to that target right there. Not a bad move. It ultimately worked its way lower. Does hit the target, see? Here's an interesting sequence. You can see right there entering into the chop zone, and the entry is below the 50 EMA. Now remember what I said, you could make a little key level adjustment if it's not too far to get it above the 50. But the chop filter also would prevent you from going long here because you're below the 50, you can only go short. And notice the short setup right here, and that one does trigger in, and it doesn't quite go far enough down. And then it turns around and you actually get a long signal to stop and reverse. Now remember what I said, that you want to move your entry up a little bit, try to protect the trade you're in, but respect the fact that the market could be turning. Okay, now that's against the 50, right? You're below the 50, so how come you could take a long trade? Well, if you look down, you'll see that you're no longer in the chop zone. And that trade triggers in. Now, also identify that trade, because that trade is based on this group of dots here. 1, 2, 3, first green bar over the signal line. And it's measuring from the low of this bar to the high of the same bar. Remember, it's the low of the group of 3, the high of the group of 3, and then that's being projected above the setup bar, up. Okay, it does trigger in. You have another white trade, and that's because you have another group of dots that even went lower than this one. So remember the rules. A group of dots is lower than the one to the left and the second one over to the left, and that also qualifies this one, which is lower than the one to the left and the second one over. So you get 2 white trades in a row, but you're already in this white trade. And notice that if you stop and reverse, this stop was all the way up here. And so by getting long here, you're cutting this trade's loss by a significant amount, and instead you're getting long. And it does come down But this stop is down here, and it barely holds, and it ultimately works its way up, hitting all its targets. You see, now there's another green trade, and that's going against the 50, right? It's a long trade, but you can't go long because you're below the 50 EMA, because you're now in the chop zone again. That one worked out also. But a small adjustment, you could have pushed it over, or you just ignore it because you're already in a trade. But it is a good example of the filter eliminating what would be a winning trade. So we give up some winning trades when we use a filter, but in exchange we also avoid bad trades, and that's the trade-off. That's how the chop filter works. What is the chop filter exactly? On this chart I'm showing you two indicators. The red lines represent an indicator called the Bollinger Band. I'm sure most of you have heard of that indicator. It's a common indicator that comes with most trading platforms, and it measures the volatility of price action. The magenta lines are a Keltner channel, and you'll notice that the Keltner channel is a lot steadier. It's measuring something completely different than Bollinger Bands. We're not really interested in how the Keltner channel works. It's not part of the strategy. What we are interested in is when the Bollinger Band moves inside the Keltner channel, like right here. And we're also interested then in when it moves out, back in and out. When the Bollinger Bands move inside the Keltner channel, the price tends to get compressed. When it breaks out again, it often opens up into really nice moves. John Carter uses this idea. He calls it the squeeze setup. It's one of his signature setups. When we talk about a squeeze, we're not referring to this. We don't use this idea in the way that John Carter does. All we're interested in is identifying when the Bollinger Band moves into the Keltner channel, and then we're not going to take trades against the direction of the 50 EMA. That's it. That's how we use this idea. So when I put on the HT chop indicator, you'll see exactly what I mean. Okay, so here's a look at the same chart, and notice that when the Bollinger Band moves inside the Keltner channel, the first bar is green, and that warns us that it just moved inside. Notice that it comes out a little bit right here, and the bar is green again. Then it comes back in. You notice it has red dots again. And when it finally moves out is here on this green dot. The green dot is a dot that shows you where you can get a lot of power. And I almost think of it as a jet propulsion bar, because it could really push with energy when the price is compressed, like a cork popping out of a champagne bottle. And so you want to look for those, because those can give you some nice setups. Okay, look what happens when I put on the calculator and the 50 EMA. Of course, I also put on our signal line. So notice when we get into the chop zone, the Bollinger Band pushes into the Keltner channel. See the setup against the 50 EMA right here? That's a trade you're going to avoid because it's in the chop zone, even though you have green dots. Of course, 2 bars over, it's red again, and it still hasn't hit the entry. But the principle is you're not going to want to take the trade against the 50 EMA. Now, look at what happens on the long trade. The long trade is above the 50 EMA. You're still in the chop zone. You're still in the zone where the Bollinger Band is inside the Keltner channels. In fact, it's in that zone for several more bars. However, the rule says because we're above the 50 EMA, we could take that trade. And it sets up a really nice move, hitting all its targets, preempting the exit of that price, the exit of the Bollinger Band by several bars. Okay, so we don't need to be afraid of trading inside of this zone. We just want to be selective. And we also don't need to have these lines on the chart. Let's start to look more like the counterpunch right there, you see. But you see what these dots tell us is very valuable. But we're using the concept of the Bollinger Band squeezing inside of the Keltner channel, or pushing inside. I don't want to use the term squeeze because we're not using it like a squeeze. We're using it as a filter to eliminate some trades, the ones that go opposite or opposed to the 50 EMA. And that's how we use that filter. It's the only way. So sometimes you'll have the chop filter showing you that you're in the chop zone, but the price isn't really firmly below a trending market or above a trending market. It's right on top of the 50 EMA, which is kind of moving horizontal and sideways across the chart. When this happens, there's a higher risk of a losing trade triggering in because the price just doesn't have enough power to get above or below. At some point, the price will break away, as we see right here. But notice that you get a long trade here. It's above the 50 EMA, which means you could take it. It triggers in, and then it comes back down and stops out. In fact, this price tries to break lower, and it fails. Then it comes back up again. But notice the second try, above the 50. You could take it, and that one makes for a nice move. Now, it would have stopped out when it came back down at money management for only a partial profit. But you can see the idea. If you take away the money management strategy and you don't move your stop, obviously it was a nice move. So remember that there's never perfection in what we do. We're just trying to put the odds on our side. Now, the other thing to always notice is this is a time of day when we would not be trading crude oil anyway. But it is a nice example that shows what could happen when you're in the chop zone. Here's another look at what could happen, and it shows you how useful the chop zone can be. You're in the chop zone here, so you're not going to go long because the 50 EMA is down. We're below the 50 EMA. We can only go short. And so instead of long, you take the short, comes down, and look how it gets to that target. Absolutely perfect, right? Looks like there was a news event in here as well. In fact, both these trades end up working out. Notice that you have a long trade here, and you're not in the chop zone yet. Remember, this is at the right edge of the chart. You'd be looking at it like this, and you have a long trade, and it triggers in. Now you're in the chop zone, but you're already in the trade. So you don't just jump out of the trade. You stay with the trade. Once you're in the trade, you stay with the trade. Comes down. You're in the chop zone. Stops down here. And the stop holds. And it comes up. Now there's another trade. This trade now you're in the chop zone. You're below the 50. Can you take that trade? No, you can't. First of all, you're in this one. Second of all, this one is in the chop zone. You're below the 50. You can only take short trades. When I say below the 50, the entry is below the 50. Okay? And it's a good thing because that one, notice the white trade comes up and hits target 1. The green one, it's a bigger trade, and it just can't get there. And instead it comes back. It almost gets there, but it doesn't. It fails. Now you're in the chop zone again. When this trade shows up in the chop zone, it's below the 50, and that's a trade that can be taken. Of course, another filter that we use all the time is time of day. And I would recommend that you never trade the Euro-US in the afternoon during the US session. Not a good time to be trading this market. So time of day could also be a filter. And that's explained inside of the trade plans themselves. All right, so there's another filter. We're going to go back to the original example when I started showing you the chop zone. And this filter is really simple. It's a filter that eliminates trades that are just too small. So while this particular trade would be eliminated because we're in the chop zone and we're trading the wrong way, right? You don't go long. There's another reason we would cancel that trade, and it's because it's just too small. Sometimes you get these setups that are too small and they're not worth our time. My general rule is I want at least target 3 to be 10 pips or 10 ticks on a futures chart. And I will ignore target 1 and target 2, and I'm only going to take profit at target 3 when a trade is that small. But that's the smallest trade I'm interested in. When I click on this trade and I look at the entry at 1167, and target 3 is only 3 pips above it, or 4 pips, 1171 say, that's a trade that's just too small. And when you put in spread, there's just no way to make money with a trade like that. Now on the short side, you'll notice that, yeah, that's true, this one's too small also. 1158 to 1155. I mean, it's just too small, 3 pips to target 3. But you can catch a move with the trailer. Not really. In this case, it turns right back around. I don't care. I don't want to take trades that are that small. So I eliminate them. That's a filter that I'm going to eliminate. Trades that are too small. Okay, and the typical concept is you want to get at least 10 pips to target 3. And you might need more. If you're trading a pair where your spread is more than 2 to 3 pips, even a 10 pip trade may not be worth it for you, because if you go 10 pips and you pay a 3 pip spread, you only made 7 pips. So you may want to force that trade to actually have a 12 pip target or a 13 pip target to offset a few pips of spread, so that the minimum profit you would make if you hit that target was 10 pips. And we have a tool built into the calculator, which I'm going to show you on another video, where you could actually filter out and turn those trades off. So I just activated that filter, and notice how all those small trades disappeared, cleaning up this chart and helping you stay out of the choppy price action. Because a lot of times when the price is choppy, the price is compressed. Perhaps you're in the chop zone, which means you could get setups that are too small. So by merely using the small trade or small setup filter, you eliminate a lot of the noise on the chart. It's a very simple concept and it's very effective. Alright, I'm going to show you one more filter on this video. This is called the squeeze filter. This is not the squeeze that I referred to earlier, showing you the Bollinger Band and the Keltner channels that John Carter likes to use. No, we refer to squeeze as a completely different concept, and it works like this. When the 50 EMA is above the 200 and it's pushing down like this, pushing down to meet the 200 EMA, this zone inside gets pinched, and we're using the term squeeze. We're calling this the squeeze zone. Okay? And when you're in the squeeze zone, there's a simple rule that you're not going to take a trade against the 50 pushing down. So you can see it because we know that the 50 likes to push down, find the 200, and possibly push below it. Of course, this is right at the end of the session. It's a time of day we're not typically going to trade. But there's a good example here because you have a long trade that's going against the squeeze zone. You have short trades that work out really nicely. Okay, you could take short trades. You just don't want to take the long trade against that 50 EMA. And of course, the opposite is true when the 50 EMA is coming from below to above. Here's a great example of the 50 pushing from a below, pushing up to meet the 200 from below to above. When we get the setup inside the squeeze zone here, we're not going to go short against the direction of the 50 EMA. Now, coincidentally, it's also in the chop zone, but if it wasn't in the chop zone, we still would eliminate that trade. We are going to be able to take longs in the direction of the 50, and those indicate a nice move higher. Remember, when that 50 is starting to turn up to meet the 200, this is a testing zone. And what we're looking for is it to resolve to the upside. It's not always going to happen. There's going to be times when it's going to start to turn and go the other way. We may be taking short trades, I don't know. But a large percentage of the time, it's going to continue on up. It's going to meet the 200 and it's going to cross over. And when we catch the turn in the 50 EMA here, we're getting in at the early stages of that move. And so notice you're in the chop zone. You can take long trades. It's above the 50 EMA. This is why we like to do this. You're not going to take short trades inside of the squeeze zone as it's pushing up or inside of the chop zone. It just so happens if this came down and hit this entry to go short, we'd have to decide if we were going to stop and reverse to short. And remember what I said, you would just merely add a few more pips. You try to protect the long trade, but respect the fact that the market could turn and head lower. But quite often you get setups that are possible setups that don't trigger in. And that's fine. The strategy is very efficient. And by using these simple concepts, notice how all these nice setups work out. Even the big one here comes up and hits that target. The next one comes up. Look at how close it got to target 3 there. You know, eventually one of these setups is not going to work because, you know, you get multiple longs in the same direction. Ultimately, one of them is not going to work. Purple one got pretty close to target 1, though. Look at that. So this would have stopped out on the other side of the signal line for a partial profit. Even this green shade came up. If you just miss a target by a fraction, you have to be a trader and take some profit. You use a concept that we call trade for profit. Okay, you have to give the strategy a little bit of margin. So if you barely miss a target and you're taking profit at target 1, target 2, target 3 and trailing with Forex, that's what I suggest you do. You could see it went from 98 all the way up to 08 or even 09, and it got as high as 084. That's a 10 pip move. You might not want to take the profit off of all your position, but you certainly want to take a quarter of your position off. Maybe you get off somewhere down in here, and then you're moving your stop up to protect yourself with the rest of your position. And of course, we'll explain this further in the rules of the trade plan, but I'm just trying to show you how you use the targets. And if you miss a target by a fraction, by a tiny bit, a small percentage, trade for profit. You earn the right to take some money off the table. Price has moved nearly to one of your objectives, so you have to be proactive. Nothing's perfect in trading. Here's a sequence on the Russell E-mini. Notice it looks just like any other chart. We really didn't change much. Didn't change anything. But notice you get a short trade here and you're in the chop zone. Even though it's on the green dot, that still counts. That's the chop zone. Doesn't trigger until it's in the red zone anyway. But it's the chop zone. And you don't take it because you're above the 50. You can only take long trades. And it prevents a losing trade. In fact, when you get over here, you get a long setup here. But notice that this would be a counterpunch trade and there aren't any targets. So that's a warning that you could get a counterpunch setup. Remember, the cyan line has to cross from below the yellow line to above the yellow line. And when it finally does, you get a new setup. The calculator's smart enough to know not to print two setups on the same bar. And whenever you get the new setup, that's the setup that you're interested in. You always go to the new one. So we no longer have a counterpunch setup. We now have a failed swing level, right? This failed to come down and make a new low. It made a higher low and then started to move up, and that's your green setup. You're in the chop zone, but you're able to take the long trade because you're above the 50 EMA. And notice how it breaks up, comes up and hits a nice target 1. Continuing with the sequence, you get a counterpunch trade short. And notice that the 50 EMA is straddling. Okay, you got to be concerned that that could be support, and this might not have enough energy to get down to target 1. But you're not in the chop zone. You're not in the squeeze zone. There's no reason to not take that trade if that's the next trade in your trade plan. That just happens to be a trade that's going to fail. It's going to turn around and stop out. That's what a losing trade looks like. but something interesting happens. You get a new failed swing level to go long, right? Because this failed to come down and break the last group of exhaustion dots. It's another higher low. When you see the exhaustion dots resting on or near the 50 EMA, that is a great clue that the next trade that results from those dots has a great chance of succeeding. So I look for these situations. And look what happens on this setup. Triggers in on the next bar, right? Here's your third dot, first green bar. There's your setup. It's a nice big setup. And look at that thing go. So you want to look for the situations where you have your exhaustion dots resting on or near the 50 EMA. And since it's above the 200, the trend is up. It's making higher highs and higher lows. Look at the high trend. All the stars are in alignment. The exhaustion happens right at a major support area, giving you a great setup. You learn to watch for these situations. You could even learn to specialize. Notice when we go back to here, this is resting on or near the 50 EMA as well. Look at when that one triggers in, how it's able to pop up and hit a target. You're going to see that a lot now that I've pointed it out to you. It's not a filter. It's not trying to avoid losing trades, but it is giving you a hint on setups that might have higher odds, better odds in the favor of that trade succeeding. All right, on the next video, I'm going to switch directions, and I'm going to teach you a whole nother way of trading the Counterpunch Express. We call this the trend mode. Up to this point, I've been showing you the standard mode. The trend mode introduces a new indicator, and it is a new filter. It's a pickier way of using the strategy that focuses on taking trades that are only with the trend itself. So we'll get into that, and I'll talk about some ideas and ways that you may want to use trend mode with the Counterpunch Express. I'll see you there.